So guys, April was a pretty eventful month for me on the market. I completely sold out of one position, then replaced it with a brand new one. And on top of that, my account took a bit of a hit, which we'll be talking more about in this month's portfolio update. So with that, we're actually going to switch it up today, and I'm going to have my good friend Dylan send us off into the intro. Dylan?
So without further ado, let's get into it.
All right, my friends, what is going on? It's so great to see you guys. My name is Ryan Williams, and here I show you how to take steps towards financial freedom by investing in dividend stocks, which I believe is the easiest way you can create passive income right now. Twice a week, I'm coming at you guys with new videos on the topic of dividend stocks, and today I'm going to share with you what happened in my portfolio over the last month. So to dive into that, let's jump over to the screen. All right, guys, so we are taking a look at my dividend portfolio tracking spreadsheet on Google Sheets that I made. And if you guys want to grab a copy of this, there is a link to it in the description of this video. It's totally free. All you need to do is click the link and it will open up a more blank templated version of this spreadsheet you guys see here. And what you guys need to do, step numero uno, if you're going to use this spreadsheet, once you click the link and open up the template, you need to go to File. You'll need to go to make a copy, and then you'll need to actually hit make a copy here. And once you make a copy of this spreadsheet, it will then allow you to start inputting your own data. That's very important. You won't be able to start inputting any of your own data unless you make a copy of the spreadsheet. So please, 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 don't forget to do that. All right, so as far as my portfolio goes, guys, it is currently valued at $36,400.77. And today, as you can see, it's taken quite a hit today. This is a huge red day for me, probably the biggest red day I've had all month. And we'll talk more about this portfolio's performance across the last month in just a moment. But before we get to that, guys, I want to share with you my annual dividend income, which is currently sitting at $1,587.33. Now, when we did the update video last month at the beginning of April, my annual dividend income was sitting at $1,574.75, which means that we've only gained about $13 in dividend income in the last month. And I haven't talked about this for a while, guys, but right now I'm about 80%, just under 80% of my goal to hit $2,000 in annual dividend income by this September 22. But to be honest with you guys, while we're on the subject, I don't know if I'm going to be able to hit it. Anyway, getting into my portfolio's performance across the last month. For those of you who don't know, I have two different stock portfolios that I invest into every single week. I've got my main portfolio, the dividend stock portfolio you guys always see. I always talk about it on this channel, and I keep that on Charles Schwab. Then I have my M1 Finance Roth IRA that I started at the beginning of this year. And for the month, both portfolios are down quite a bit. So just in the last 30 days, my main portfolio is down 1.15% or about $400 in unrealized gain. The market value has gone up. We've gone up about $200, almost $300 in market value in the last month, but this is coming just from the contributions and the dividend reinvestments. The stocks themselves have not performed very well, which is why we're seeing this loss across the last month. And the same is true in my Roth IRA on M1 Finance. We saw an increase in market value, but we lost some unrealized gain. This says I'm down 7% in the last month in the Roth IRA, which is pretty insane. But overall, with these two portfolios combined, my overall loss in the last month is 1.32%, or just under $500. Year to date, we're seeing a very similar story. Officially in the red year to date, and I'm down 1.2% across both of these portfolios, which equates to about $400. Technically, though, it's not a loss until you actually sell, so I'm just gonna stick to that. Anyway, guys, moving on, I want to show you my best and worst performing stocks in the last month, and that should paint a picture as to why we are down so much in the last 30 days. So going over to Seeking Alpha, a lot of my positions actually did pretty well. Snap-on up 7% in the last month, Coca-Cola up 6.9%, Southern Company up 6.5%, and then a couple more that are up over 6% with Realty Income very close to it. But really, all the ones that are in the green, the worst performing one that was still positive was Johnson & Johnson, who still gained 3.17%, which I still think is a pretty solid gain. But getting into the biggest losers, no surprise, AT&T is at the top of that list, down 18.64%, which a lot of this is just due to the spinoff finally be complete. So they adjusted AT&T's share price to account for the spinoff. Moving on, Starbucks is down 13.35% in the last month. Year to date, guys, it's down nearly 35%, which is unreal. I've been swooping up so much of this company, which you'll see in just a moment, but this is why, because it's down so much. And then Intel also took quite a hit, picked up a little more Intel this month. AWS AUR took a hit, Verizon, Lowe's. So I had a lot of stocks just not do well. And apparently, guys, the weight of the losers overtook the winners for the month. But that's okay. It's creating some discounts in this portfolio. I'm totally happy picking up some discounted Starbucks. I love being able to buy some more cheap Intel. And also Lowe's, the newest position in my portfolio. I really like seeing it come down. At a certain point, it was under $200 per share, and I would not be surprised if it gets back down there. Now, with that said, let's move on. I want to tell you about not only my purchases in the last month, but the stocks that I sold as well. Starting with my sales, this one's going to be no surprise. You guys already know this. I made a whole video on it. I sold out of WBD, Warner Brothers Discovery, which is the spinoff company from AT&T. And I had 24 shares of WBD that I sold for $578.89. And what I did with that money is I reinvested it back into my portfolio and swooped up some shares of what I think are better companies. Now, that brings us to the next point, which is my purchases in the last month. Starting with Intel, I invested $100 into Intel and got 2.18 shares of that in the last month. And next, I loaded the boat on Lowe's. I put all of my Warner Brothers Discovery money into this company and started this new position. And across the entire month, I invested about $710 into Lowe's and picked up about 3.5 shares. Next, I invested $250 into Starbucks and increased my position by 3 shares in the month of April, which is nice. We are making our way to 30 shares total. Maybe in the month of May, we'll get there. We'll see what happens. And next, I invested $100 into Snap-on and picked up 0.6 shares of Snap-on. In the month of April, I kind of backed off from investing in Snap-on so I could allocate more of my funds to other companies like Starbucks, which is obviously very discounted. We just saw that a moment ago. And also Lowe's, which I said is the newest position in my portfolio. So I'm really trying to work on building up that position. And last but not least, guys, I invested $200 into the Roth IRA on M1 Finance and spread that across 5 different ETFs. And I'll talk more about that in just a moment. But my total purchases for the month of April comes out to $1,359.98. And going back to the Roth IRA for just a moment, guys, I actually did make a pretty substantial change in this portfolio in the last month. I sold out of one of the ETFs in this portfolio. I got rid of VXF, which is the Vanguard Extended Market ETF, and replaced that with SCHD, which is the Schwab US Dividend Equity ETF or something along those lines. And I want to give you a couple reasons why I did this. So scrolling down, just taking a look at the dividend stats, starting there, look at the difference not only in dividend yield between these two ETFs, but also the dividend growth across the last 5 years and the years of dividend growth. So SCHD just appears to be a much better ETF to hold if I'm looking to build up that dividend income. And also not just the dividend income, just overall performance, SCHD is outperforming VXF pretty much across all time frames. So going back as far as we can here, SCHD across the last 10 years has outperformed VXF. The same is true in the last 5 years. The same is true in the last 3 years. And the same is true even in the last year and year to date. So that's why I swapped out VXF for SCHD. And hopefully that makes sense. And I would actually be curious to hear your guys' thoughts on that move in the comments below. So drop me a comment and let me know what you think about that. Now, scrolling back up, guys, let's go over to my watch list. I want to talk about some of the changes in my watch list across the last month. So first things first, I removed Jout, Jout, Johnson Outdoors Inc., which is a super small cap company that makes outdoor equipment for things like fishing, camping, stuff like that. It actually seemed like it had pretty strong financials. The dividend stats weren't too bad, but it just wasn't an industry that I was looking to invest in. So that's one change I made to this watch list. And another one, guys, I added Scotts Miracle-Gro to the watch list, actually, which is a company that I've been trying to learn more about these last few weeks. And I'm really psyched about it. For those of you who aren't familiar with Scotts Miracle-Gro, it is a company in the lawn and garden industry. You will have no doubt seen their products if you've been into like a Walmart or a Home Depot or a Lowe's. They are probably the most popular brand company in this industry. In the last year, it's down nearly 57%. Just year to date, it's down nearly 40%. Okay, in the last month, it's down close to 18%. So the stock is definitely getting more affordable over time. Now, before we move on, just the dividend stats on Scotts Miracle-Gro, I will say aren't anything super spectacular. I mean, the dividend yield's pretty average, 2.6%. The payout ratio is 32%. 5-year growth rate's nothing crazy either, under 6%. And then the dividend growth history is not too bad, 12 years of consecutive dividend growth. And the dividend stats also kind of have me on the fence. Not that they're bad, but I know I have other positions in my portfolio that are going to have more to offer from the dividend. I mean, Starbucks, as an example, has a very similar forward dividend yield. The payout ratio from Starbucks is higher, I believe, but the 5-year growth rate is considerably higher as well. And they have very similar dividend growth history. So I look at that and think, well, maybe I'd be better off just contributing more to Starbucks. Starbucks. I'm not sure, something I'm chewing on, but I wanted to share my quick thoughts while we were talking about my watch list. Now, as far as the moves that I plan to make in the month of May, there are a couple things that I will address. Number one, I definitely plan to continue contributing to stocks in my portfolio like Lowe's and Starbucks and Intel for reasons I covered earlier in this video. That's not going to change, just going to keep on keeping on there. And then number two, I am chewing on the idea of selling out of JEPI and also XYLD, which are two of the highest yielding positions in my portfolio, both covered call ETFs, and also both were never intended to be long-term positions in my portfolio. For those of you who've been watching my content for some time, you'll know I invested in those two ETFs just to put some of the cash in my checking account to work until I found a better use for it. Now, having said that, the more time that has gone on, the less I see myself recapturing that money and putting it back into my checking account. I feel like I'm good enough financially to just keep that in my portfolio. And having said that, if it's going to stay there, I kind of think I would rather have it in more higher conviction, long-term picks, like some of the stocks I mentioned a moment ago, the Starbuckses, the Lowe's, the Snap-ons, Intels, stuff like that. So that's an idea that I'm chewing on. And once again, I would actually appreciate your guys' input on the matter. What do you think is a good move to make here? Anyway, guys, that's what's been going on in my neck of the woods this last month. If you're hungry for some more dividend stock content from me, then click on this video right up over here. And also, if you're interested in seeing more videos like this from me in the future, then hit that subscribe button right over here. I'm putting out 2 videos every single week, so there's a lot of good content coming your way. And with that, thank you guys so much for watching. I hope you have a great day, and I will see you in the next one.